Good morning. Thank you for coming. If you're online, thank you for logging in. My name is Lev Menand. I'm a professor here at the law school, and it's my great pleasure to introduce Michael Su, who's been heading up the Office of the Comptroller of the Currency since 2021. As you may know, the OCC is one of the country's most important financial regulators. It charters and administers the federal components of our nation's banking system. It's also one of the oldest continuing parts of the federal administrative state, dating back to the Lincoln administration, 1863. And in my view, Mike has been one of the greatest leaders of the office in its history, compiling easily, I think, the best record since the Truman administration. In his capacity as acting comptroller, Mike also serves as a director of the Federal Deposit Insurance Corporation. And previously, he headed up large bank supervision at the Federal Reserve. So this is a person who has been involved in regulating our banking system and is involved in regulating our banking system across the sort of full panoply of federal agencies. This morning, he's going to share some reflections on recent developments that I think are of great interest here and in Washington. And so with that, let me turn it over to Mike.
Thanks so much for that very, very kind introduction. It's a real honor and a pleasure to be here at Columbia Law. And I really want to especially thank Lev for hosting this event. So as Lev alluded to, today I would like to talk about bank liquidity risk. And with the one-year anniversary of last year's large bank failures fast approaching, it's a good time to reflect on lessons learned and to discuss how best to ensure the safety and soundness of the banking system going forward. The characteristics of bank runs are changing. Banks and regulators need to adapt accordingly. As the speed of banking and finance accelerates, so too does the need for better brakes to enable a safe and sound system. Some adaptation has already taken place through supervision on an individual bank-by-bank basis. Careful consideration also needs to be given, however, to targeted regulatory enhancements to help ensure that updated liquidity risk management practices are implemented and sustained systematically and consistently, especially across mid-sized and large banks. I'll start today by reflecting on the events of last year and sharing preliminary thoughts on the contours of what targeted regulatory enhancements might look like. I'll then close with some thoughts on how the adoption of faster payments and tokenization might impact liquidity risk management in the future. Let me start with lessons learned. The failures of Silicon Valley Bank and Signature Bank last year highlighted three vulnerabilities that had been underappreciated. First, uninsured deposits can be withdrawn quickly en masse. Second, having liquid assets is necessary but not sufficient for banks to endure acute liquidity stress. Banks also need to be adequately prepared and have the operational capacity to monetize those assets quickly. Third, contagion to healthy banks does not require interconnectedness and direct exposure to a failing bank. Systemic threats can occur via guilt by association, i.e. shared uncertainty with regards to seemingly similar risk profiles, such as high reliance on uninsured deposits for funding. Before diving into each of these, I think some context is helpful. Uninsured deposits in aggregate have grown considerably since 2009. The FDIC reported last year in May 2030 that uninsured domestic deposits increased at an annualized rate of nearly 10%, from $2.3 trillion in 2009 to $7.7 trillion in 2022. The FDIC's report also showed that an increasing number of banks are relying on uninsured deposits. Over the same period, online and mobile banking have become ubiquitous, enabling depositors to place and withdraw deposits more quickly and easily. And the decentralization and faster dissemination of information associated with the rise of social media platforms has also had an impact on everything, including financial markets. This combination of these developments significantly increased the liquidity risk of banks with uninsured deposits. As we saw with SVB, a run by uninsured depositors can occur much faster and be substantially more severe than bank runs of the past. A couple data points. On March 9th, SVB endured over $40 billion of outflows. That's roughly a quarter of its total uninsured deposits on a single day. By contrast, in 2008, Wachovia lost $10 billion of deposits over 8 days. And Washington Mutual lost $19 billion over 16 days. Of course, not all uninsured deposits are created equal. SVB's depositors were highly networked. The vast majority of them were startup technology companies, many of whom knew each other personally and interacted frequently. They relied on the same small group of venture capital investors for funding, advice, and counsel. In short, the conditions were right for herd behavior. Herding is not limited to venture capital technology startups. In 2008, hedge funds acted as a herd, running en masse from prime brokers like Bear Stearns, Morgan Stanley, and Goldman Sachs. Last March, crypto companies ran en masse from Silvergate Bank and Signature. Shortly after, high net worth individuals withdrew their funds en masse from Credit Suisse. From a liquidity risk management perspective, it's important to identify ex ante where such herding might occur. Prudently categorize such deposits and applying appropriately high stress outflow rates is one way to do this. The liquidity coverage ratio, LCR, for instance, requires large banks to hold high quality liquid assets sufficient to meet stressed liquidity outflows over a 30-day period. The outflow rates for wholesale funding from financial institutions are high, reflecting the runnability of those counterparties. By contrast, the outflow rate for retail demand deposits is low, 10%, reflecting their stickiness. One problem highlighted by the failures of SVB, Signature, and Credit Suisse is that some high-risk deposits, including uninsured deposits, are categorized as retail demand deposits for LCR purposes, resulting in an under-calibration of risk. Better classifying high-risk deposits to better capture the heightened risk of herding and applying the appropriate outflow rate to help address this risk more effectively. Second, let me talk about the ability to monetize. The faster pace of bank runs is another change that banks and regulators must adapt to. When massive outflows can occur over hours and days instead of weeks, it isn't enough for a bank to have a sufficient quantity of liquid assets on hand. Banks must also be able to monetize those assets, i.e. convert them into cash in a timely manner with a high degree of confidence. Otherwise, the liquidity value of those assets for the risks they are meant to cover is illusory. Banks have two market-based options for monetizing assets, sales and repo. To avoid fire sale dynamics, banks typically focus on repo. In acute stress scenarios, however, repo may not provide sufficient amounts of liquidity fast enough. Prudent liquidity risk management should consider constraints on the speed and ability to repo substantial amounts of such assets over time. Of course, the Federal Reserve has the capacity to provide large amounts of liquidity nearly instantaneously via the discount window. Bank utilization of the Federal Reserve's discount window faces two hurdles, however. The first is operational. Without proper preparation, monetizing assets can take time. When depositors can make withdrawals with just a few taps of the finger or clicks of the mouse, the window for action is quite small. This timing risk can be mitigated by banks identifying ex ante the assets that will be pledged to the discount window as collateral and pre-positioning them accordingly. In addition, periodically borrowing from the discount window can help ensure that banks are capable operationally and operationally familiar with what it takes to borrow from the Federal Reserve in the case of stress. The second hurdle to discount window borrowing is sticking. Since the 2008 financial crisis, banks have worried that news of their borrowing from the discount window could be perceived as a sign of weakness, thereby exacerbating the run. As such, many banks believe that instead, they will face a Hobson's choice. The option of borrowing from the discount window is not a real one in practice. This increasingly matters for OCC supervised banks. Mid-sized and large banks supervised by the OCC have over $12 trillion in deposits, of which $4.8 trillion, roughly 40%, are uninsured. increases in the potential size and speed of liquidity outflows at OCC supervised banks heightened their vulnerability to discount window stigma. One solution would be to explicitly give banks credit for their discount window borrowing capacity to cover ultra short-term acute outflows like those endured by SVB and Signature. This would make clear that regulators expect banks to, in stress, to utilize the discount window to help cover short-term liquidity outflows where needed. This regulatory expectation could help to destigmatize the discount window usage. Some have argued for adopting this approach within the LCR by adding discount window capacity to the numerator and expanding the sources of liquidity beyond high-quality liquid assets, or HQLA. That would be dangerous. I believe it's more appropriate and prudent to take a narrower approach and limit the discount window credit to covering only acute, ultra short-term outflows, up to say 5 days, through a new targeted liquidity requirement. In short, I believe a new targeted regulatory requirement for mid-sized and large banks to have sufficient liquidity to cover stress outflows over a 5-day period warrants serious consideration. The denominator should consider the potential speed and severity of uninsured deposit outflows, while the numerator should consider the liquidity value of pre-positioned discount window collateral in addition to reserves. The rule should also clarify operational preparedness expectations related to the discount window, perhaps even including a requirement that banks do periodic test draws. Predictability and repeatability are critical to consider. With an ultra short-term horizon with pre-positioned collateral, banks, regulators, and market participants can be fairly confident that the Federal Reserve will make discount window liquidity available in a timely manner as needed. That confidence declines the longer the time horizon and if the collateral is not pre-positioned, as there's then more room for counterparties and functional regulators like the OCC to question whether the central bank will in fact provide and or maintain liquidity support. While destigmatizing appropriate discount window usage is imperative, it's equally important to minimize the risk of inappropriate discount window over-reliance. The line between being a lender of last resort and providing a bailout can be a fine one, especially in stress. Adopting a separate liquidity requirement for ultra short-term outflows could provide a safe space for appropriate discount window usage while maintaining a credible stance against bailouts and longer-term stress scenarios. In short, the adoption of a new, well-crafted regulatory requirement could help destigmatize the discount window while maintaining the anti-bailout conservatism of existing liquidity regulations. Third, let me talk about contagion. The contagion risk from the failures of SVB and Signature is worth unpacking because it differs from prior contagion events. In the 2008 financial crisis, the risk of contagion stemmed from uncertainty about the extent to which losses might be transmitted across the financial system through interconnectedness. When Lehman Brothers filed for bankruptcy on September 15, 2008, no one knew who had exposure and might bear outsized losses. The so-called breaking of the buck at the reserve fund, a money market mutual fund that held Lehman commercial paper, was shocking and triggered broader market panic because it made the fear of interconnectedness very real. The extraordinary government support to AIG several days later was provided out of a similar concern about the financial system's exposure and interconnectedness to that distressed company. A couple of years later in Europe, the prospect of sovereign debt defaults by Greece and other countries fed contagion and financial stability fears based on very similar concerns. By contrast, the contagion risk from the failures of SVB and Signature was not due to interconnectedness, but rather a fear that uninsured deposits at any bank could be at risk. While the customer profiles of the uninsured deposits at SVB and Signature were understood to be fairly unique, market participants did not have the means to quickly and credibly differentiate the behavior of uninsured deposits at other banks. In other words, there was guilt by association, casting doubt on the uninsured deposits held by a wide swath of banks, which threatened to destabilize the financial system. The long-term solution is to credibly contain the scope of association. For instance, most would agree that the portion of uninsured deposits representing excess funds has a riskier liquidity profile than the portion used to fill specific business purposes, meeting payroll, paying suppliers, et cetera. This is the distinction between non-operational and operational deposits. Banks define these differently, however, in part because their customers and business models vary enormously. There's no standardized classification system that market participants can see and trust. On top of that, the deposit landscape has been evolving and shows no signs of settling down. For example, the rise of banking as a service, rapid growth in reciprocal deposits, and innovations in payments and treasury services. To get a better handle on this, in June, the OCC will host an economics symposium for invited academic and government researchers on deposit gathering, franchises, and risk profiles. Our hope is that focusing on this may contribute to efforts to credibly classify and differentiate deposit types, which may help contain the scope of any guilt by association and thus help mitigate contagion risk in the future. Before I conclude, I want to say a few words about liquidity risk in the future. In the US, as we transition towards a faster payment system and possibly tokenization of real-world assets and liabilities, banks may need to further enhance their liquidity risk management capabilities to keep up. Historically, banking has proceeded in daily increments. Bank tellers balance their books and cash positions reconciled at the end of each day. Around this daily cycle arose batch processes, whereby inflows and outflows over the course of the day could be netted, managing the amount of funds flowing through the system, providing opportunities to correct mistakes. Many banks still operate this way today. The future looks different. The time increments are shrinking towards always on, 24/7, 365. Instant payment systems are becoming the norm abroad. For instance, in the UK, Brazil, India, Singapore, Thailand, and others. The Federal Reserve's FedNow service is a real-time interbank 24/7, 365 gross settlement payment system. With FedNow, financial institutions can settle payment transactions anytime, including nights, weekends, and holidays. In addition, to the extent tokenization reduces settlement frictions, it will also accelerate the velocity of banking and finance. This creates the potential for great benefits, including improving financial inclusion and financial health for many people. But a future of faster, always-on, real-time money flows also creates new risks. Faster payments can lead to faster fraud and limit the ability to remediate erroneous transactions. The instantaneous nature of real-time payments necessitates enhanced liquidity risk management, third-party risk management, and fraud and compliance. As the speed of payments accelerates, we need to think carefully about the associated risks and control. Banks and regulators should start working now on building the right brakes for more real-time financial systems. So I want to conclude where I started. The characteristics of bank runs are changing, and banks and regulators need to adapt accordingly. We need to develop better brakes to keep banks safe and sound and to mitigate systemic risk. I believe it's possible to take a targeted regulatory approach to address the lessons from the failures of SUB and Signature. And I look forward to working with my interagency peers, banks, academics, and other stakeholders on this important task. Thank you.
Thank you so much. I'm not a journalist, but I'm
guessing on TV.
Yeah. That the newsiest sort of part of your remarks this morning was the idea of a new ultra short-term sort of 5-day liquidity requirement. And you make a really strong case that high-quality liquid assets aren't of much use if you can't monetize them quickly, and that more than ever, sort of banks need to be able to do that. Things are moving faster. And you spoke a little bit about the LCR, which is sort of the short-term liquidity requirement we currently have. And I'm wondering if you could just say a little bit more. Does March 2023 sort of show that our current LCR failed its first big test? Does it also need updating? How should we think about the sort of optimal liquidity rule space sort of 3 years out from now?
So the short answer is I do think it needs updating along the lines I discussed in my speech. We can get back to that. But I do want to maybe step back for a moment. I think the LCR is a really underappreciated success story. And I think maybe it's best told kind of through an analogy. Lev, I know you've talked a lot about regulation, supervision through the lens of driving, regulations on driving cars and things like that. Imagine if there were no speed limits. If you had a world with no speed limits and people just kind of drive whatever speed they think is safe or whatever drive speed they want, that can work. There's going to be accidents. And as the system evolves, that can lead to a lot of uncertainty about what's going on. And once you have speed limits, what does that do? Speed limits enable greater amounts of certainty between drivers about, okay, we're now all going to go 65 plus or minus. It enables folks to get from point A to point B faster and safer. And once they're in place, they kind of get taken for granted. We now take them for granted, and they work in the sense that it enables folks to get from A to B faster and safer. And I think of the LCR in a similar way. Like the LCR, since it was in place, it has done a lot of heavy lifting that's pretty invisible to folks. And we take it for granted. And I think that that's a good thing. Now, what happened recently is that parts of the LCR, and really pretty targeted parts, are undercalibrated. And so we've got to fix that. And I think that really gets to this, if you're applying a 10% outflow rate to something that's flowing, in SUV's case, 40% on a single day, that's a mismatch. Now there's different ways of addressing that. And we want to work through the process of what's the best way to do that. But that's the general theory there.
Yeah, that's great. And it segues to what I was going to ask you next, which is how we should think about the relationship between rules and standards. Yep. And so you sort of gesture to driving, which is the classic example, where just because you're complying with the speed limit doesn't necessarily mean you're in the clear. If you're driving unsafely, you can still be pulled over. And in banking, this is also true. You're subject, if you're a bank, to bright line rules, to regulations, but you're also subject to the law's requirement that you operate a bank in a safe and sound manner. That is the standard. That's the safety standard that applies to banks. In law schools, we have the sort of rules versus standards debate. When should we have rules? When should we have standards? Sitting at the top of an organization that both supervises and regulates, that has standards and rules to enforce. I'm curious how you think about when a rule is appropriate. And to be a bit more concrete, how do you think about sort of the downsides of the rule? You just sort of emphasized some of the great strengths of the LCR and of the rules that we have. But rules can be costly because they can potentially crowd out supervisory judgment, for example. And so, how do you think about when we should bring a new rule in and how we should manage that mix?
So I think it's really, really critical. We have to have both. You have to have rules. You have to have, in equal parts, strong supervision. And because rules are good for, what are rules good for? Rules are good where, like a speed limit, it's public. Everyone's abiding by it, or everyone who's in scope for that rule is abiding by it. You go through a process, an administrative process, you get comment. Like that's really, really, really valuable. And it provides a degree of consistency and transparency that has a lot of value. Now, one challenge with that I've kind of come through across my career, and I think this happens a lot, is that, and you allude to this, sometimes the rule gets substituted for being able to do everything. And rules are necessary, but they're not sufficient for safety and soundness. It's not a substitute for judgment. And so you have to have, in equal parts, judgment, whether it's risk management judgment at a bank or supervisory judgment over that. And it begs the question, why? Like, why can't we just have a set of rules and just leave it and forget about it and let it run? It's because the world is very complicated. It's messy at times, and it changes all the time. And because of those changes, rules are generally fairly static. The way they're constructed, they can adjust in certain ways, but really, for that predictability and consistency, they're relatively static, whereas supervisory judgment, discretion, standards, principles-based, you can really go with what the situation is at the time, either for a particular institution, particular environment. That's really, really valuable. And so, we're probably going to belabor the driving example here, but until recently, DC has not had snow in a really, really long time. And recently, I took my kids on a trip to go skiing, and it was snowing quite a bit. You have to drive very differently in those conditions than if it's dry and sunny. That's common sense. The rules don't necessarily, it's hard to hard code that into rules because the range of weather outcomes is just really, really, really wide. Unless you want to have a really, really complicated rule book. And then you've gotten into issues of, well, how do we balance that, which you allude to, like we have to enforce that, and compliance and all those other things. So there is a balance there that has to be struck. I think maintaining that balance over time can be tough. And I think it's one way to do that is to not over rely on one or the other at any given time. I think there is a temptation to say like the rules will do all the heavy lifting or that supervision will do all the heavy lifting. I'm a paranoid person. I think it's good for regulators and supervisors. There's a healthy level of paranoia to say, well, what if the rule can do a certain amount, we need some discretion on top of that, or discretion can do a certain amount, but we need rules on top of that. I think it's a healthy way to approach that.
I could ask you about rules and standards all day, but let me move to a different topic. Although I can't help but note the oddity of the driving example, which I think is really useful. It's the classic example. It's really useful for illustrating the difference, but of course it involves a rule that everybody breaks all the time. I mean, nobody complies with the speed limit. And so you see just how complicated rule enforcement can really be. So I want to just touch briefly on the discount window, because one of the things that was really interesting to me about your remarks was the way in which the discount window interacts with liquidity regulation, because both are trying to solve the same sort of problem. And the liquidity rules are relatively new. The discount window has a very old history. That we started that in the United States in 1913, and yeah, England has been doing it much longer. Problems with the discount window as a solution, have cropped up at various points, and as you alluded to, in the sort of contemporary period of the last 20 years, there's been a lot of concern about stigma. Maybe even the last 70 years, discount window use has been in decline. I'm curious if you can elaborate on your sense about whether the discount window is still our primary tool for preventing bank runs. It needs to be a more important part of preventing bank runs. Is it at its most successful when perhaps it's never used? One theory of the case is you just create the discount window and then nobody ever thinks they need to run on a bank ever again. And so I just want to invite you to say a little bit more about the discount window.
Sure. So maybe I think there's a legitimate, like, why am I talking about this now? Like, why are we talking about this now? And I go back to the problem we're trying to solve. Bank runs are faster. So they're faster and the amounts. So what happens when they're faster and the amounts involved are higher? The purpose of the discount window is to provide short-term liquidity to a solvent institution. You can go back to Lombard Street and Badgett, like that dictum still applies. And if bank runs are faster, it's especially salient. But here's the problem. Okay. Under the LCR is a 30-day window. So if you have sufficient liquidity as measured under the LCR for 30 days, that doesn't help if you can't get to the weekend, right? You need to be able to get to the weekend. And that means being able to convert whatever you have into cash. And the most reliable way to do that is through the discount window. And we can set that up in a way that is consistent with our principles and our understanding of how that should operate. The challenge is, and we've learned this kind of the hard way, getting to the weekend also doesn't help if the way you do that essentially accelerates the run. Because the negative signaling associated with discount window use, as we know, the market is looking for negative signals. And since the crisis, that's been associated. So we've had this tension. There's this tension between these two imperatives, and we've really struggled to how to solve it. Like, how do we solve this? because you don't, we've at a global level, we talked about for LCR purposes, how do we have a liquidity regime that doesn't induce over-reliance on central banks for liquidity? Because that potentially puts you on a slippery slope to a bailout, and you have moral hazard. And we don't want to do that. It's really, it's like a key lesson from 2008 is that we can't cross that line. We lose trust. Everything is based on trust. We lose trust. So we have to hold that line. But we also now, as bank runs get faster, we have to solve for this stigma problem. And so I think the way to do that is to have a separate requirement, ultra short term. And the shorter it is, the better, because it's very, very certain. You pre-position the collateral, it's very, very certain. It's very reliable. It's never going to, it's super short term. It's not going to be a bailout. That's what the central bank is there for. You can define it. If you can define it, it can be credible. And credibility is everything. Because you can say, create the discount window, but if it's never actually going to be used because of the stigma, it's not credible and it's not going to serve its function. So we have to solve for this set of constraints. And I think this is one way of doing it. Now, of course, the point of this speech is to put the idea out there. This is a proposal, and we're talking this through with our federal banking agency peers. When it's ready, we'll put that out for proposal and get lots of comment. I think institutions like Columbia this is exactly the forum that I wanted to present it to get the best ideas on how to kind of noodle through this complex set of issues, because it's really, really critical that we have a solution to this.
Great. So I'd love to ask you a little bit more about March 2023 and how we should think about those runs. And you call them, I think, guilt by association sort of runs. Some have called them sort of runs on the business model. And it struck me that if you look at the sort of long history of banking, that this isn't new. So in the panic of 1907, there was a run on New York charter trust companies that was basically a run on the business model. It started based on some contagion and interconnectedness, which is sort of the other mode of run that you talked about. But then it spread to entities that just sort of were operating in the same business model as the Knickerbocker Trust. And you can also sort of think about the 2008 crisis as also involving a run on the business model, that business model being broker-dealers that are repo financed, that are outside of the bank regulatory perimeter. And so Bear Stearns was the first of such business to come under strain. Lehman was the second, but the remaining ones all would have fallen, I think, if steps hadn't been taken. So that's Merrill Lynch and Morgan Stanley and Goldman Sachs, none of which continue today outside of the bank regulatory perimeter. And so I'm curious what lessons we should draw from this sort of history and the run on the business model for thinking about the business models that failed in March 2023?
It's an excellent question. One of the interesting things about once you're in that panic mode where runs are now a possibility, a lot of the presumptions flip. And by that, I mean, banks then need to be able to prove credibly to others that they're different. And how do you do that? And it's all about credibility. How credible are you in doing that? So as you pointed out, Lev, in those examples, there wasn't a credible way. The market did not believe that when, after Bear failed, Lehman said, no, we're different for the following reasons. The market didn't buy that. Now, there have been examples where the market has bought that. So I think it's interesting to think through a couple of other counterexamples. If you remember, like MF Global was a smaller broker deal, it failed. And then there was a lot of questions about Jefferies. Jefferies did not fail because Jefferies was able to provide enough information that the market said, oh, okay, that's credible. There's no problem here. We're going to move on. And so I get back to this credibility point because then it sharpens our minds. So like, well, what are credible ways to differentiate? I hear all the time banks, around this period, Bankers are saying, we're different, we're different, we're different. Okay, prove it. And then they talk through, and I think a lot of banks did this with their clients. And they were able to walk through with their clients, here's how we're different. And so that was able to stem some of that guilt by association. How do you do that on a market-wide, systematic basis, ex ante? Like that's the policy question. Are there ways to do that? And one of the challenges is uninsured deposits is one big bucket. It's just a big bucket of stuff that even if a bank says, no, we're different, I think the market participants in these stress scenarios tend to look sideways. They're not just talking to the bank, they're talking to their peers. And if the peers say, you know what, I'm not so sure, it doesn't matter how much belief they have. If their peers are saying we're out, they're going to have to get out as well. This is why banking and finance requires supervision because of these fragilities, and they're not easy to solve. Because when times are good, there's great benefits to having the system operate in this particular way. We just need to have tools and the ability to limit these to where the risk is, where it rightfully is. We can't eliminate all problems. Problems come up. But can we keep that to where it is and manage it and have a system where those collateral impacts on healthy institutions are minimized? And that's kind of what we're trying to do.
That's great, and I need to chew over a little bit more of the counter examples. In the meantime, I want to just sort of drill down on the uninsured deposits a little bit, because that strikes me as the real feature, the most troubling feature of the business model that ran into trouble in 2023. And so Silicon Valley Bank, I think, had 97% of its deposits as uninsured deposits. And in some ways, if you're 97% uninsured deposits, you look a little bit more like a shadow bank than a bank, in the sense that a lot of the short-term money instruments that you are issuing are not explicitly government backstop, which makes them much more prone to runs. It's, as a general matter, people don't run when the U.S. government has its full faith and credit behind the instrument. When it doesn't, and there's a question about that's when we get run-like behavior. And I guess my question is, how much of this runnable stuff do we want to have in the system? And is there really a space to differentiate? And how would we go about doing that? Business models that say are banks with more than 50% uninsured deposits, is that just sort of like walking trouble?
So I think if the approach that we've been taking is to focus on the risk. So if the risk is appropriately identified and is appropriately measured, and you have the right calibration of how to mitigate that risk, then I can be a little bit more indifferent to what the business model is, because the business model will influence what economically can be supported by the business model. So the counterfactual is, had the appropriate outflow rates been applied to this, and had this idea of the ultra short term, had that been in place, could that business model have survived? Question mark. And if it had survived, would it have been able to withstand the kind of run that endure? Question mark. And I think that's the policy exercise that we go through, right? We have to think through, because there's everything's iterative. It's not fixed. And so that's an important thing to think through. The challenge with the business model, approaching it as just do I like or not like a business model, these business models, they change all the time. And depending on how you define it, it'll simply change to another form, and you may or may not have addressed the risk. And so we tend to take a risk-based approach. What is exactly risk? Let's try to define that specifically as possible. Now, I think to Lev's point, that can add up to a particular business model. For instance, with the investment banks pre-2008, which looking at it both top down and bottom up is the way you need to kind of attack that problem holistically. I agree with that, and so you have to do both. But I think it does help to have a grounding in that kind of risk identification and that calibration there, and then step back and say, okay, big picture, where does this leave us in terms of what else needs to be covered?
Great. Okay. One more big picture question. I'm just going to put my cards on the table, and most people here, many people here might know sort of my view about this, but March 2023, it seemed to me, was an indictment of the deposit insurance system in the sense that the uninsured deposits are very unstable, proved very unstable, and that our system for stabilizing them was creaky and difficult to operate. And the whole episode felt very 19th century to me. And I'm pleased that you mentioned Bagehot and Lombard Street. You know, it's like we're back in 1873, a little bit too much. In that, in the 19th century, the U.S. had rolling banking panics every decade, and they were extremely disruptive to social life, to economic growth. And we were able to escape rolling banking panics through a variety of innovations. In many ways, the most successful was deposit insurance, but deposit insurance came with sort of a built-in limitation of the cap. And I guess my question, and there may be limits to how much you can get into this sort of pie in the sky sort of reform stuff, but is the cap really helping us at this point? Why should we have demandable deposits that aren't government-backed ex ante, but really public policy turns out to require the public to stand behind them ex post anyway? Shouldn't we just sort of call a spade, explicitly insure demandable deposit account balances, and that will save you a lot of time on liquidity risk management rules and ultra short term, and that could be the the blue sky way out of this.
Okay, so I'll kind of answer this in two ways. The first is we have to think about bank liquidity and bank liquidity risk through at least three perspectives: deposit insurance, regulation, supervision. All three are interrelated. And to the extent that one is doing a certain amount of work in terms of liquidity, the other two then have to step in and fill those gaps. So what I'm talking about today is assuming for now that there's no change to the deposit insurance regime. And that's in part because Congress needs to make those changes. We can't make those changes as a regulatory matter. That has to be determined by Congress. Now, one of the hats I wear, I'm a director on the FDIC board, and the FDIC put out a report on deposit insurance. It's a great report. It's actually, your students have probably read it. It's like the history of deposit insurance, which is great, and three options for consideration. And those three options were very succinctly summarized as either unlimited insurance. I think that's we'll call that the LEV recommendation.
For demand deposits.
For demand deposits. Raising the cap to some other level, or putting business payment accounts, basically transaction, those kind of business payment accounts under an insured regime, which some other jurisdictions have done. And there's pros and cons to each of these. Like, there's no perfect option. And the paper does a great job of laying them out. And the FDIC in that paper has a slight lean towards that third option. Because I think the view is that it kind of balances some of these pros and cons across the first two options. So that's out there. There's no consensus, either in Congress or by bankers or by academics or regulators, as to what the best option is. That makes reform very challenging. If there was a consensus on, say, option 3, then I think this would be a very different conversation. But so far there hasn't been. And so in the absence of consensus and movement there, we still need a safe and sound banking system. That's my job. That's part of my job. And so we have to then look to these other two, regulation and supervision, about how to get there, so that you can all go about your daily lives and not worry about your deposits. That's a mature, stable, good, healthy banking system. And so that's what we're doing. And part of what we want to do is kind of consider those policy tweaks that can do that more efficiently, more consistently, more credibly. That's what we're talking about. And I'm really looking forward to the debate and the ideas that follow from this as to how to best get that right.
Awesome. So since we've got a bunch of students here, I think it would be great to take a few minutes to talk about sort of careers in public service, how you get into public service. And some of you might know that Mike is a lawyer. And so he went to law school, and I think is in a good position to sort of reflect a little bit and share with you guys what it's like to try to go from law school into basically bank regulatory policy. And so I would love just to hear a little bit about how you made your way to get where you are now.
Thanks, Lev. So I did go to law school. I went to NYU, and when I graduated, I have had a public service orientation from the beginning, and going into, which was, as many of you know, most of the chatter about kind of jobs and tends to be towards the private sector, which is fine. But the public sector, so I went to the Fed first as an attorney, and I did a lot of reg pay work at the board. This is back in 2002. And it was so much fun. It was great because the perspective that you get to see how the whole system works. A, you don't have to bill hours, which is not a small thing. Talk to your friends who are billing hours. It's not a small thing. But B, you're working in the public interest. Like, the whole point is to understand what is going on. How is it working? So if you're curious and you like to understand how systems work, in addition to the details, because you can't just stay at the high level. You can't just stay in the clouds. You got to get into the details. You have to know the regs and the laws and how those things work. It's great. It's fantastic. Now, I happened to join at a fairly quiet time. So it's 2002, 2004 was, in the scheme of things, I think one rule was passed a year. Like, that was a big deal. It's quaint. I think for some of us who've been around, you can look back at it as a kind of a quaint period. And I had the luck, the honor of being able to work on a bunch of supervision projects while I was an attorney. And those really interested me because it also took kind of knowledge on policy matters, on regulatory matters, and made them very real. Some of these dealt with people who were getting hurt by a particular bank, banks who were running into safety and soundness concerns. Just made it very concrete. It's very interesting. It's a little bit more quantitative. So for those who like to exercise both parts of your brain, you can do that in public service. There's lots of opportunities to do that. And then I ended up going to the SEC and joining that prudential supervision program over those investment banks. The SEC's brief experiment with prudential supervision from 2004 to 2008, I was part of that program. And you learn a lot. This is one of those, it's a great way to learn because you don't just learn about one institution or one business line, you're learning across a bunch. And I don't think it gets enough. I remember once working, I was working, and there were a bunch of bankers who were telling my boss at the time, you're going to lose all of your people because they know too much. Like, we're going to wave lots of money in front of them. We're going to poach all of them. They know too much. None of us left. It was too much. We were learning so much, and it was too much fun. And you really feel like every day you're doing good for the American people. Like, that's a really, really, really good feeling. It's hard to quantify it, but it's why I've been a government public servant my entire professional career. Anyway, so I encourage it. The OCC, we've got a great program. So I got to put it in the blog. Excellent law program and just supervision in general. So just highly encourage folks, check it out. Check it out, not just for the OCC, just government in general.
Yeah, and I'll add, if you are interested in working at the OCC, send me an email. I would be happy to help facilitate the submission of your application materials. I think we have a few more minutes if there's questions in the audience. All right, Daniel.
Could you say a little bit more about your vision for pre-positioning? Is this something that would happen when a loan is made or sometime after the loan is made? Like, exactly when does the collateral get pre-positioned at the discount for that?
Sure. So the pre-positioning is those are existing assets on a bank's balance sheet, and the prepositioning is to the discount. So think of the discounted window as essentially the lending arm of the Federal Reserve, and it's identifying it ahead of time. Right? It's basically saying, if you're the bank, you say, hey, I've got this set of assets. I'm basically holding on to them. And when I need to, I'd like to pledge them and then convert that into cash that then you can use. And it's doing all of that ahead of time. If you don't do that ahead of time, it's not pre-positioned, then you're showing up one day and saying, here, please lend against these particular assets. That can be hard to do in the heat of the moment, especially if it's a lot of different assets that are that haven't been checked, because the Federal Reserve, as a lender, has to have confidence that what it has is good collateral, fits within their collateral schedule, follows all those different rules. It's just doing all that prep work ahead of time. And so it minimizes that uncertainty and makes things go much, much, much faster.
So it's just like identification. You say the balance sheet, the Federal Reserve will say, this asset is eligible for this amount of.
Yeah, that's all worked out between the bank and the Federal Reserve, the Reserve Bank.
And you're not proposing that the pre-positioning would be done any differently. It's just
no.
Right.
It was just using standard practices.
Right.
Yeah.
Let's try somebody I don't know. Yeah, in the back there.
My name's Charlie. I have what else? I was actually wondering, kind of going back to your earlier point about credibility coming from banks saying that they're different. I feel like there's a bit of a trade-off when it comes to increased supervision actually converges banks into one specific business model that actually works under like heightened supervision.
Mm.
So I was wondering how, as a regulator, do you balance like that risk of like everyone having a conversion because supervision requires it to, like everyone to converge, as opposed to encouraging more innovation or differentiation?
Okay. So the question, just for those, was about how to think about supervision contributing to a convergence of business models. I think, from understanding your question, right? So I think that's a misconception. Supervision is tailored to the banks. So the way at the OCC, we do have heightened supervisory standards for banks that are $50 billion in assets and above. But that simply means if you're over $50 billion, you're going to get some extra attention. And we put in a rule, like, here are our expectations for risk management. But those risk management expectations don't dictate a particular business model. They simply say, if you're going to be a big consumer lender, we will approach that as a big consumer lender versus commercial lender versus a trust bank, et cetera, et cetera. So it's tailored. We don't have a view as to appropriate or inappropriate business models. We care about whether the risks that the business models are taking are appropriately being risk managed and capitalized. We have liquidity buffers, et cetera. We're agnostic as to business models as long as it's safe and sound. And that we've got a free market system. We think that's good. To the extent there is convergence, I think it's often due to a bunch of different forces. Sometimes it's technology. Sometimes it's competitive forces. It can sometimes be due to regulation, but I think that tends to be overplayed depending on the context of the discussion. So it depends on how that's being discussed. But we do diversity in the banking system is a very good thing, because we have a very diverse economy. So we need an equally diverse banking system. That's important. It's got to be diverse. It's got to be competitive. And those are important considerations for us.
I think this is a very interesting question. I just can't help but say, I do think you see convergence in some sense after 2008, but it's a product of sort of, I think, what you're referring to, which is we now impose regulations that force certain risks to be taken into account that previously hadn't been taken into account. And so then certain business models did start to disappear because now those risks had to be internalized.
Yes.
And that led to a lot of convergence, but it was the sort of good convergence of the sort of we were externalizing these risks previously, and now we're internalizing them.
And to be clear, convergence was not the policy objective.
Yeah.
Right. The policy objective is to make sure that the risks are internalized. And if another way, an academic way of thinking about it would be, prior to that, there's some shadow subsidization that's happening that's leading to a distortion. And so you get rid of the distortion, and it's how it actually should be. That's the objective. the convergence or not convergence is a byproduct of that. And we do have to be mindful of not having kind of a monoculture around banking. So that's something we want to be definitely mindful of, but it's not a policy objective per se.
All right, one more question I'm going to do from this side of the room. Yeah.
Thank you so much for the talk. You mentioned the potential proposal that to tweak the LCR from a 30-day period to a 5-day period. But what academics posit that actually the formula isn't so much the problem, but some of them think that it's the classification of HTM and AFS securities. So I was wondering if that's something the OCC is looking into as part of the proposal.
Yeah, so we're looking at all the above. And to be clear, what I'm proposing is not a switch from the LCR to make them complementary. So to go back to the speed limit analogy, keep the speed limits on the highway. That's important. Add speed limits to the off ramps is how I'm thinking about it. That 5 days, almost like that off ramp. Like, maybe we should let folks know 30 is a good speed limit for that, rather than having them wipe out or not knowing how others are approaching that. But yes, you're absolutely right that the LCR issue can be solved through classification. Part of this is it's classifying and the alpha. You need to match both of those, and that's important. And so there's different ways of approaching that, but that's your instinct on that is spot on.
Maybe we could squeeze in one more question. Yeah.
I'm a journalist. I wrote a story earlier, just recently, about Prashant Bhardwaj, who was hired as the OCC's first fintech officer. His resume was full of lies, and he left sort of in unexplained circumstances in the middle of last year. The OCC hasn't commented on it because it doesn't comment on personnel matters, but the issue goes more towards vetting of potential candidates, whether he accessed information that he should have, and whether the regulator has the skills to be the supervisory body that it wishes to be. I'm just wondering, did the OCC review this matter? What changes has it made to its vetting process? And how did it happen?
I think let's take this question offline, and let me get a question from a student. Yeah.
Hi, actually, I'm not a student. I work in a regulatory think tank. I just want to echo the regulatory side is much more fun, in my opinion. I want to thank you for being here today. You've talked a lot in the past about financial stability and the risks of too big to manage and too big to fail banks. You've suggested that regulators might consider breaking them up. I'd like to ask a question about one way that banks get much bigger, which is mergers. And we know the Justice Department is reviewing its merger policy. But one thing I wanted to ask was, it's been about more than 2 years now since the Biden executive order on competition, which asked the OCC to work with DOJ on tightening up those bank merger guidelines. And I guess the question on my mind is really, how is the OCC thinking about bank merger policy as a way to help the agency interdict those too big to manage and too big to fail problems upstream more towards the source?
All right, 30 seconds.
So I'll be saying a lot more on this in the near future. So
could you give us a teaser, maybe?
I'll be saying something on this in the near future. Well, I encourage folks to pay attention to that, because this really deserves a whole fulsome hour of discussion and plus, because it's so important. I guess I'll go back to, the core point is we have a large, diverse, dynamic economy, and we need a large, dynamic, and diverse banking system. And we want those to match. And merger policy is one way to help get there. And in order for that to match and to ensure that we've got a safe and sound system that's also financially stable, these are all imperatives. We have to do all of these simultaneously. And so I'll be saying more about this in the near future, and look forward to having you at that talk. And I can delve into more of that.
Thank you.
All right, please join me in thanking the conference.